We're now going to go through an example of a balance sheet. So you guys have done great. You've made it through most of the videos. This is the last one. So we're going to celebrate. We're going to watch an interesting video and then kind of base our example on that. So I'm going to pull up the video here and we'll take a look at this before we get into it. So as you're watching this video, just have some time to think about what assets, what liabilities this company would have. Think about what you're seeing, what Dan's saying, and then anything else you can think of with running a business.
So Blake and I met in university, and he started brewing in university in the backyard as a function of drinking cheaper. The rules were a lot different then. There was a minimum production capacity. That rule changed, and then we just hit the ground and got this building and got some tanks. What we're trying to do is make beer approachable, and we want to tilt people's perspectives away from macro beers into craft beers. So right down to our beer pricing, dogs being allowed in the brewery, kids being allowed in the brewery. It's all about accessibility. We don't really care too much about it being polished. That's not our thing. As long as you can sit down and be comfortable, that's all we care about. You'll see in the background all the pool noodles insulating the tanks. That was a function of being cheaper, and it just happened to be colorful and eclectic, and that's our vibe. So just a bunch of different decision making like that formed this like total mishmash of stuff. We wanted people that have not familiar with it at all to come into the space and find one of those beers in the lineup that they're going to enjoy. And so it was important for us to have a wide variety. So we have 7 mainstays, and then we have 4 to 5 creative taps always rotating. That we'll just do one-offs, sour beers, squid ink IPAs, like really weird stuff. We're just trying to make good beer, and that's it. Everybody talks about the brewing industry as being super collaborative. We're sharing beer gas. When somebody runs out, we'll run it down the street on a Friday night, which literally happened last night. The collaboration is definitely a true thing. This is the Red Smashed in Buffalo Jump. This is my favorite beer. It's the maltiest beer we have. We're a very malt-forward brewery. We focus on the grain in Alberta. And Blake did about 12 iterations of this just to get the color right. And I still love it.
Okay, so that's just a fun video of Cold Garden Beverage Company. There is the company. And Dan is actually the brother of Laura Allard, who I used to work with at MMP. So I've heard about their bar. I've actually never got a chance to get down there, but one of these times when I'm in Calgary, I'll need to stop in. It obviously looks like a really fun place. Dogs loud, that type of thing. So cool bar. Just a little fun video to get you relating what we're learning about to real life. So some examples that you guys might have there. What were some assets you saw, liabilities they would have as a brewery? Take a thought on those. I mean, you saw in there they had the tanks for brewing. They had couches and tables, furniture. Obviously, they would have beer that they're selling, cash that they're collecting from the sales, probably some salaries payable to pay the bartenders. So lots of different things that they're going to have as assets and liabilities. So just a good link now when you're learning about accounting and thinking of those in the real life world of real life businesses and what they're looking at and what they have in their company. So this is the example we will do. As a class, we have decided to pool our money together and start our own craft brewery. It was our first year of operations. Our year end is August 31st, 2019, and the following are balances of accounts as at August 31st, 2019. So we need to determine first whether each of these accounts is an asset, a liability, or equity, so we know where to put it on the balance sheet. And then after that, we're going to prepare the balance sheet. First thing we've got here, furniture and equipment. So it's different companies will do it differently, but you don't have a line or an account for every single item. So within furniture and equipment, you would see the tanks, the tables, the couches. That's what's lumped into this $105,000. So what type of account is that? Well, it's something that we own and it's useful to us. So this is an asset. shareholder capital. Well, we know capital is that equity balance, so this is an equity account. If it is a corporation, remember shareholders are the owners of the corporation. So an August year end, it's called shareholder capital. That are both hints to us this is a corporation. Accounts payable. Okay, so we have to pay somebody, so we're going to be giving out money. This is a liability. Accounts receivable, the other side, we need to collect something, so that's good in the future. It's a benefit to us. That's an asset. A bank loan that is due to be paid in 3 years. So again, we need to pay something. That is a liability. Cash, everyone loves cash. That is an asset. Prepaids. Now we haven't really talked about those yet. Prepaids are something that you have paid for in advance. So you've prepaid this. This maybe is prepaid rent, let's say, as an example. So these guys don't own their building, or us, sorry, we should say. We don't own our craft brewery building. We're just renting it. And typically for rent, you need to pay that at the first of the month or the month ahead. So because it's paid at the first of the month, it's not an expense yet until we get through the month and we've used it. It's paid early, so we still have future benefit, which is us being able to use that space for the next month. So there's a future benefit. We've paid it early. So this is an asset. Once the month goes by, and we've used up that benefit because we've already taken all of the time that we've paid for, this rent would then become rent expense. And we will look at that in future chapters. But right now, we still have the benefit coming up for, it must be the month of September 2019. Since this is the end of August, we've maybe paid that rent for September of that year. So that's an asset. Salary payable. Again, we're paying someone something, so this is a liability. Beer inventory. So this is the finished goods. Once we've already brewed the beer and it's ready to go. And inventory, again, that's what we are going to sell to our customers. So we will be receiving a benefit when we sell that and get cash. Inventory is an asset. And then we also have raw materials inventory. So the hops, the flavors, the grains, all those different pieces that are made or that are brewed to get to our final inventory. So this is typically separated out when you see a company who produces some sort of good. But it is still an asset. It's just a separate type of inventory. All right, so now number 2, we're going to prepare the balance sheet. And we're going to look at this. The textbook doesn't go into it yet in in chapter 1, but it does in the future. And again, I think it's a good idea to just show you these things right away. So we're going to prepare what's called a classified balance sheet. And these look at classifying or separating current assets from long-term assets and current liabilities from long-term liabilities. And when we say current, it means, or it's reference to 1 year. So a current asset is something that you will use up within 1 year, or that is available to you in a year. So cash, that's available right now. You could use that up in a year, it would be current. Whereas furniture and equipment, you're likely to have those tanks and those couches for more than 1 year. So that would be a long-term asset. For liabilities, it's the same idea. The current liability would be something that is due or that you need to pay within 1 year. If it's something like this bank loan that doesn't need to be paid for a year, so it gets paid with or in more than 1 year, so the bank loan, you're not going to pay it for 3 years, this is now considered long-term. So we'll take a look and we will separate out our balance sheet that way. Now it's possible to either do assets on one side, liabilities and equity on one side, like we saw in the previous example, or you can do assets above, get a total, liabilities and equity below. Either way is fine. Just because our page is laid out this way, I'm going to do them side by side. So we will start, again, we always name our company first. This is Craft Brew Co. It's our company name. We are creating the balance sheet, and it's at a specific period of time. So as at August 31st, 2019. And we will start by creating our asset side. And as I said, we're going to separate this out into current assets and long-term. We go back here. The first asset we see on the list is furniture and equipment. And as I said, we're going to have this for more than 1 year. It's going to provide benefit to the business for more than 1 year. So this will fall under long-term assets. We've got furniture and equipment. And the balance given to us was $105,000. Flipping back again, the next asset that we see is accounts receivable. Now, a business is not going to sell something on credit and expect to be paid in more than 1 year. Typically, you get 30 days to make a payment, so 30 days that this company will collect their AR. Therefore, it is a current asset. So accounts receivable, but just to save time, I'll put AR. And that balance was $1,600. The next asset in the list is cash. Again, because cash, we have it right now, it's available to us to spend right now. It is a current asset, $6,250. We've got prepaids is another asset. Also, a company wouldn't typically pay something like rent. We talked about this being prepaid rent. You're not likely to pay rent for more than 1 year. That would just be poor use of cash by a business. So prepaids would fall under current assets as well. And our prepaid rent was $5,000. Next assets are our beer inventory and raw materials. And in the same line of thinking there, you can't create beer to last more than a year. It could go stale, it could go bad. So that beer inventory would be a current asset. As well, the raw materials. You're not going to buy so much that it would last you for more than 1 year. So that would also fall under current assets. Inventory goes under current assets. So we've got our beer inventory, which was the finished goods. And then we've got the raw materials inventory. Beer, we had $22,250. Raw materials was $14,900. And those were all of our assets on the list. So we want to, because we've separated this, to make these statements the most useful for the users. That is why we're separating this. And to make it very useful for them, we're going to show total current assets. The users want to be able to look really quickly at the statements and see all of these subtotals. They don't want to have to do the math themselves. So our total current assets, we add that up, is 50,000. We then add that to our long-term assets, and we get total assets of $155,000. Okay, so halfway we've got one side of our accounting equation. Now we need to complete the other side. So we'll have our liabilities and our shareholders' equity on the other side. And like we've classified or broken out our assets into current and long-term, you do the same thing for liabilities. Whoops. So we will start with liabilities, and we'll first show our current liabilities. Okay, look back. The first liability we have on the list is accounts payable. Now, long-term or short-term, do you guys think? Well, accounts payable, remember, goes with accounts receivable. And I said over here that AR, you're not going to, or someone won't grant credit where you're not going to get paid in more than a year. So if we think of that on the accounts payable side, same thing. You're going to have to pay that likely within 30 days. So in a shorter period of time than a year, accounts payable will fall under current liabilities. That is $4,500. Next liability we have is our bank loan, which is due in 3 years. So it's due in more than 1 year. So that is a long-term liability. That will go down here. Bank loan, it was $100,000. And then the last liability we have salaries payable. I know me as an employee, I'm certainly not going to wait more than a year, so salaries payable will also always be in current. That was $2,500. Again, that was all our liabilities. We're going to show our subtotals here for the users. Total current liabilities. We add that up, we'd get $7,000. And we also need to show our total liabilities. So we're always breaking up what we put on a statement into useful information for the users. So we're not going to just get a very ending total of the total liabilities and equity. We also want the users to easily just be able to look and see the total amount of liabilities that are due. And that is $107,000. So knowing, just looking at this without looking back to our list of accounts, we can figure out, or at least hopefully know, what our owner's equity is going to be, what that section. So that's what will come next, is shareholders or owner's equity. Because it's an August year end and we know it's a corp, we can say shareholders equity. Owner's equity is fine, it's just that general term because a shareholder is an equity. But I've put shareholders equity here. So we know from the accounting equation, total assets equals total liabilities plus shareholders equity. So we know the total assets. We see our total liabilities here. So the difference between those two needs to be what our shareholders equity is for our accounting equation to balance. So we want that to be the missing amount, which if we do the math, 155 minus 107 is 48. So let's hope when we flip back here, the one account we have left is our shareholders capital. And thankfully it is 48,000. So we're going to put that here. Shareholder capital 48,000. Because we've only got one line item, we don't need to write below it, say total shareholders equity. It's obvious if there's only one thing there, that is the total. So now we'll add our liabilities and our equity to get our ending total of total liabilities and shareholders. And again, just to save space, I put S/H. That's a common way to refer to shareholder. Total liabilities and shareholders equity, add those up, we get our $155,000. So we can see now we've got here, we clearly didn't miss anything. We've got our check because assets do equal the total liabilities and shareholders equity. So that is an example of looking at a classified balance sheet. And we'll look in our live class at why we go through splitting out current assets and current liabilities. Again, everything that we're doing is for the users. They need to use this to make decisions, to be able to see what's going on, evaluate a company, and current assets and current liabilities are important. It quickly shows how much you have as assets for the next year, how much you have to pay for the next year. So it just gives more information, and there's some ratios that we'll quickly look at in our live class that use these balances. So it's nice to have them right there on the statement for us and not have to do a separate calculation. Okay, that is it for the videos for Chapter 1. You guys made it through. As I said, we will have our live class on Thursday, September 10th. We'll go through some more examples of this, do a little bit of other review from the videos, and have some activities. So from here, you guys can, if you're feeling ready, you could start working on your My Accounting Lab assignment. Or if you want to just do a bit more practice before the live class, there is the practice questions in My Accounting Lab as well. And again, the assignment in My Lab is for marks, but those practice questions are not for marks. They're just for you guys to try out a few examples. So I will see you in our live class on Thursday.